Welcome to an introduction to economics, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. In this short podcast, we give you an introduction to exchange rates. Remember that an exchange rate is the price of one currency in terms of another currency. For most countries, the exchange rate will show variations from day to day. This is because the currency, such as the pound, is a floating currency and allowed to vary. There are a number of exchange mechanisms that have been used over the years. Not every country uses the same mechanism. In determining which type of mechanism to use, a country must take several things into consideration. Since there is considerable trade between countries, two important decisions are: how easy is it to adjust the exchange rate, and will traders have confidence in the system? Traders will not have confidence in any exchange mechanism that would put them at risk of huge losses in transactions. A government must also determine whether the mechanism would allow a central bank to intervene to stabilize rates, and whether there will be a sufficient quantity of reserve assets for the central bank to do this. For a long period of time, the gold standard was used. There are still some political groups who call for a return to this standard. The price of a currency was fixed against a particular amount of gold. Under such a system, the US dollar might be worth so many grains of gold, the British pound worth so many grains, and the Japanese yen so many grains. This would allow exchange rates to be fixed between the US dollar, British pound, and the yen. So, for example, if the pound were fixed at twice the number of grains as the US dollar, in other words, it would be worth twice as much, then the exchange rate would be 1 GBP to $2. This method prevented large-scale speculation, which arises from floating mechanisms. It did imply a relationship between the amount of gold a country held as reserve and the supply of money in that country. The chart shows the gold reserves of a number of countries, and also the reserve held by the International Monetary Fund. It is clear that today these figures do not bear too much resemblance to the size of economies, since China is now the second largest economy and Switzerland has a relatively small economy. The gold standard needed to work with the balance of payments between countries. If a country had a balance of payments deficit, then the money supply fell. Wages and prices would fall, exports would become more competitive, and the trade balances should improve. In the short term, the country was losing gold. A country that had a balance of payments surplus would gain gold. Money supplies would increase, wages and prices increase, exports would then become less competitive, and the trade balance would move back towards an equilibrium. Approximately 40% of gold is not held by central banks, and recent estimates suggest that the figure may be even higher. Most countries abandoned the gold standard for a number of reasons. There tended to be a lag before any adjustments were made, which made the system unpopular with entities trading overseas. A country that was reluctant to change a fixed exchange rate would lag. The fall in money supply tended to lead to high unemployment rather than falling prices, worsening a situation so the system was not self-adjusting. As overall wealth increased and trade increased, it was clear that a finite amount of gold would not suffice. Finally, the cost of producing, storing and transporting gold meant that the system became unwieldy. As a result, it was decided in 1944 to try and adopt a different system, known as the Bretton Woods system, after the town where delegates from many countries met. The system was under the oversight of the International Monetary Fund. A country could establish an exchange rate in terms of gold or dollars, but the system still meant trying to fix a rate for exchange. A country needed to maintain its exchange rate within 1% of parity, a very narrow limit. If a country needed to alter the rate, then it had to inform the International Monetary Fund, but only if the alteration exceeded 10% did it need permission from the International Monetary Fund. The agreement made it clear that alteration should only be made if there was a disequilibrium on the balance of payments account that was sizable. The system, known as the adjustable peg system, survived until 1972. It was abandoned for a number of reasons. There were difficulties in deciding when to devalue and by how much to devalue. This made it very difficult for international trading, since if there was a possibility an exchange rate might alter, there was considerable risk if the amount was unknown. During the period of uncertainty, speculators would take advantage and add more pressure to devalue. And the more speculation, the larger the devaluation might have to be. The deflationary policies that were designed to go with devaluation were also said to be the cause of high unemployment. Other mechanisms were used to replace the adjustable peg, some currencies simply being allowed to float. In Europe, a group of countries, already in the European Union, set up an artificial unit, the European Currency Unit, or ECU. Each participating country then set an exchange rate in terms of this unit, the ECU, or European Currency Unit. Some fluctuation was allowed, within a band of plus or minus 2.5%, which turned out to be far too narrow. If the currency were under pressure, then central banks were supposed to intervene and cooperate with each other. Any realignment outside this band required the agreement of the countries within this exchange mechanism. The exchange rate mechanism had several problems. The rate of inflation differed quite considerably between different member countries. Those with high inflation rates, which included France and Italy, were under pressure almost immediately. More stable countries, in particular Germany, put pressure on these countries to pursue deflationary policies rather than alter the rate of exchange. The result was that Germany became the dominant member, and the interest rates in each country were really being set by the lead that Germany gave. The United Kingdom had brief membership of this mechanism between 1990 and 1992. The main problems with the European exchange mechanism centred on the different rates of inflation, so several realignments were needed, and that meant that the system became somewhat cosmetic. To prevent some speculation, there were mechanisms initially to prevent capital outflow. Knowing that realignment was possible, speculators were prominent, their activity being a part of the reason the United Kingdom felt obliged to withdraw. Speculation against the French franc also caused a large realignment, and following this it was agreed by the remaining members that the band within which a currency should be allowed to float was to be raised from 2.5% to 15%. This was very similar to allowing the currency to float. The trend has been towards allowing currencies to float on a foreign exchange market. The term forex is often used for this market. In Europe, the idea of a European monetary union persisted, with the aim of moving towards a single currency. It was agreed that exchange rates be fixed between countries in the Union. The Treaty of Maastricht required each member country to have low inflation and sound fiscal policy. In reality, this meant that budget deficits were supposed to be less than 3% of GDP, and the debt-to-GDP ratio was not to exceed 60%. In recent years, as these rules were relaxed, there has been pressure on the system. In 1999, the single currency was adopted by many member countries, though the United Kingdom chose not to join. The single currency is known as the euro. The monetary policy is set by a European Central Bank, which sets interest rates for the euro area. In other words, for all the countries who have adopted the euro. There have been numerous discussions about the stability of the euro, and there was much speculation about whether it would survive when it was first launched. The chart shows the value of sterling against the euro, which has fallen recently, but which has regained some strength over the period 2010-2011. The exchange rate between the euro and the dollar has fluctuated quite widely. At first, the dollar was relatively strong against the euro, but a weakening dollar from 2000 onwards saw movement in the opposite direction. In summary, we find that most countries now let their currencies float on an open market. However, there is a degree of intervention that has become known as dirty floating. In practice, all that this means is that the government will intervene if movement tends to be excessive. It can intervene by selling foreign currency reserves to buy its own currency, if its own currency is weakening. If its own currency were appreciating too rapidly, then it could purchase more foreign currency. This ends our podcast on foreign exchange, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For further information about Parkbench Tutors, please visit parkbenchtutors.com.